Market volatility, which is like waves in the ocean, it's increasing. So to understand what's happening in the markets, I want you to imagine a storm has come over the ocean. It's stormy, it's windy, the waves are getting bigger and bigger. Now, why is this happening? What's causing this storm? Well, inflation, it's still a problem. The Fed continues to raise interest rates. We have the threat of rising taxes and the rising cost of healthcare. And all of this, it creates downward pressure on the economy and the markets, and is why so many people are worried about a possible recession and then losses to your nest egg. And if you're not properly prepared, this could dramatically affect your ability to retire and enjoy the lifestyle you want. So today, we're going to learn how to identify the risks you're taking, and we're going to compare that to how much risk you think you're taking. This is very important because all too often, those are very different answers. And it is extremely common to find that you are taking far more risk with your investments than you think you're taking. Meaning, you think you're taking one level of risk, but you're really taking quite a bit more. We'll then take a look at some great strategies that you can take advantage of to reduce your risk, yet still earn a good rate of return. I know you're going to enjoy this. Here's what's coming up. Bob and Sue, they thought moderate meant that they would not lose more than 10% if the markets go south. You see, that's pretty much how they think their portfolio is set up. Yet, when we run the analysis, all too often, they find that the way their investments are set up, that they can lose, 30, 40%, sometimes more. This portfolio, as currently constructed, should average somewhere around 6%, maybe 5, maybe 7, but let's call it 6. I'm really excited about today's topic. So sit back and relax. Redefining Retirement starts right here, right now. Saving and accumulating assets for your retirement, that's a great start. But it's what you do with your money that really matters. So how will you generate income? How will you reduce your taxes? How will you pay for the skyrocketing costs of healthcare? And how will you optimize your Social Security benefits? Welcome to Redefining Retirement. I'm Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on the toughest challenges you'll face in retirement today. So many retirees and pre-retirees, they're worried about a possible recession and how this might affect their ability to generate the income they want during retirement. So today, we're learning how to determine if your risk exposure is in line with your risk comfort level. So to begin, let's see what the markets have been up to lately. So let's look at the past 3 years. So let's go from COVID, that was March of 2020, to today. Well, during that 3-year period of time, the market is up about 100%. So this chart, it is the S&P 500. And if you look at it over the last 3 years, it has grown by 100%. So during this past 3-year period, the market grew by 100%. Now, is that normal? Is it normal for the market to increase anywhere near that much over that period of time? No, of course not. Do your trees grow to heaven? No, and neither do the markets. Sometimes the markets go up and sometimes they go down. And the higher they go, typically, the more risk in investing and the more they can drop. And based on the amount of growth that we've seen in the past 3 years and the increasing risk in the economy and the fact that, historically speaking, we are way past due for a correction, now is a great time to determine if your risk exposure is in line with your risk tolerance or your expectations. Put another way, where do you see the stock market going from here? Do you believe the markets will go higher? Or do you believe that we'll experience market volatility? And if we do, how will that impact your ability to retire when you want and enjoy the retirement you deserve? It seems that this is on everyone's mind right now. Is this market growth sustainable? Are we going to enter a recession? How will this affect me? You see it on the news. You see that, hey, there's a chance of recession. And the concern that folks could lose a lot of money, and coupled with inflation, the risk of rising taxes and rising healthcare, people are really concerned about this. People watch this show. They call our office. They sit down with one of the fiduciary advisors on my team, and we help them to create a plan for their retirement. And here's what typically happens. It is extremely common that they might say something like, I am a conservative investor, or maybe I am a moderate investor. And they have in their minds, they think, hey, if the markets go south, meaning when Mr. Bear comes to town, they might say something like, yeah, we're okay losing a little bit. We're okay losing maybe somewhere between 10 and sometimes people say 15%. You see, that's pretty much how they think their portfolio is set up. Yet when we run the analysis, all too often, they find that the way their investments are set up, that they can lose, 30, 40%, sometimes more. That is a very different scenario. And that's why we put something together for you today. You'll learn how much risk you're taking, how much money you can lose in your portfolio, and how this will affect your ability to retire and live your ideal lifestyle with a Cornerstone Retirement Risk Assessment. So let me explain how this works. First, we'll get some basic information from you. We'll take a look at how you're invested, and we'll sit down with you and show you the amount of risk you're taking, and we'll share with you some of the strategies that you can use to protect yourself. Now, when it comes to retirement planning, this is an area where you can really move the needle, so to speak, especially in today's challenging environment. And for the vast majority of people we meet with, we're able to show them strategies to significantly reduce their risk, yet still earn good returns. So if you've saved at least $250,000 for your retirement, give us a call right now for your free strategy session. We've helped thousands of clients retire securely. And this simple risk assessment, it's something that could mean the difference of today's high inflation and market volatility from derailing your retirement. So give us a call. And coming up after the break, we're going to learn why there is such a disconnect between the risk you think you're taking and the risks you actually are taking, and what you can do to make sure that you don't throw your financial security out the window if we do experience a recession. This is very important, especially due to the increasing headwinds we're facing today. We'll be right back.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
Stay informed on the latest news and events affecting retirees at cornerstoneway.com.
Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement.
If you'd like more information about financial planning, industry news, and market updates, you can subscribe to our blog. Visit our website at cornerstoneway.com. The resource request box is located on the bottom right-hand corner of the homepage. There you can submit your information to subscribe to our blog.
Approaching retirement requires a shift in how you view your investment and income portfolio. Are you making the transition successfully? Author Chris Abts, in his latest book, Maximizing Your Income, will show you how to structure your income while avoiding 10 retirement pitfalls. You'll also learn 3 strategies to create sustainable retirement income. Learn to plan for potential healthcare costs and how to avoid 4 common yet costly Social Security mistakes. The information you gain from this book may help you retire sooner and help you stay retired. Get your complimentary copy today at MaximizingYourIncome.com and take control of your retirement.
You're watching Redefining Retirement, where you can count on straightforward and objective advice on how you can make your money go a lot further in retirement. Today, things like inflation, interest rates, market volatility, they're bringing us closer to a recession. And history shows that recessions destroy the retirement dreams of millions of retirees. So today, I'm sharing with you how to prevent today's inflation and market volatility from derailing your retirement dreams. So we're learning how to determine that the amount of risk you're taking in your investment portfolio, and if that risk could derail your ability to create the income you want during your retirement. And we're asking a very important question, which is your risk exposure, is it in line with your risk comfort level, with your expectations? So in other words, is the risk you're taking, is it in line with your expectations? Now before the break, we saw that the market has increased by about 100% in the past 3 years. And we have not experienced a real sustained drop in the markets for over 15 years. So now let's spend a moment, let's focus on how you perceive the risk that you're taking. In other words, how you perceive yourself, if you will, when it comes to taking risk with your investment portfolio. So I want you to imagine that you're visiting with us and we ask you the following question. Do you see yourself as a conservative investor, a moderate investor, an aggressive investor, or maybe somewhere in between? Where do you see yourself on the spectrum? As you can imagine, pretty much every financial advisor either asks you that question at some stage, or they might put together maybe a risk profile questionnaire. They might ask you a number of questions to determine the answer to that question, meaning, what are you? Are you conservative? Are you moderate? Are you an aggressive investor? And if the financial advisor or broker knows the answer to that one question, then supposedly he or she can then build a portfolio that will match your risk profile. Now here's the big problem. It is in what is considered a seemingly simple question. It is in this area that a huge disconnect, a gaping chasm between you, the investor, and how that portfolio is actually constructed by the broker or financial advisor. So here's what I mean. Let's imagine that you could sit in my office and you could see 10 different people come through our office door. And when we ask that question, let's imagine that all 10 of them said, I am a moderate investor. I'm right in the middle of the road, a moderate investor. Imagine all 10 of them said that. Well, you will find that we immediately follow up with another question, which is simply this. That's great. What does moderate mean to you? And when you say that you consider yourself to be a moderate investor, what does that really mean to you? Here's something that's kind of interesting. You will find that every single one of them has a different answer. None of them are the same. They're all different. Yet, if they all scored the same way on the risk profile questionnaire, if they all told their financial advisor or their broker that they were moderate investors, it's amazing how all 10 of their portfolios look almost identical. So here we have 10 different answers because moderate means something different to each person, yet their portfolios look basically the same. Kind of amazing, isn't it? So we have learned that the common denominator, meaning the question you really should be asking is, how much of your portfolio do you feel that you could afford to lose in a single year? Let me repeat that. At this stage in your life, at this stage, not 5 years ago, today, how much of your money do you feel that you can afford to lose in a single year? Let's say it's 2008 again, and the stock market is down by 53%. How much of your savings can you afford to lose? Now, isn't that a better question? You see, when I ask a moderate investor that question, 9 times out of 10, they're gonna tell me, hey, somewhere between 10 to 15% would represent the most they're willing to lose in a single year. 10 or 15%, somewhere in there, that's about it. Yet, if you look at how a portfolio is set up in the financial world, if you look at the big financial companies, if they have you categorized as a moderate investor, if you tell them that you're a moderate investor, they are going to have you in a portfolio where you could lose, maybe 30, 40%, possibly more in a single year. Are you starting to see why there could be some serious problems here? So, if you consider yourself to be a conservative or maybe a moderate investor, I know what you're thinking. You're thinking, hey, 10 or 15%, that's all I'm willing to lose. But your portfolio could be set up to lose maybe 30 or 40% if the markets go bad. And that, my friends, is how you get into trouble. You see, you think you're invested one way, but as we learned, odds are you're probably not. You're probably taking far more risks than you realize. And that means that your retirement is potentially at far more risk than you're aware of. And why is that? Allow me to share a story with you. It's about a couple we met with. And now let's change their names. Let's call them Bob and Sue. Now, Bob and Sue, they're in their early 60s. They have about $2.5 million saved for their retirement, and they plan to retire in a couple years. They consider themselves to be moderate investors. And when we asked them, do you consider yourself to be a conservative, a moderate, or an aggressive investor? They said, oh, we're moderate investors. We're middle of the road. And as we learned about in the last segment, what do we ask every time? We want to know, okay, what does that mean to you? At this stage in your life, how much do you feel that you can afford to lose in a single year? They said, we're moderate investors. If we lose more than 10%, which is $250,000, boy, that's really as far as they're willing to go. Now, here's what's interesting. Their current financial advisor, he knew they were moderate. And when they went through the risk profile questionnaire, they were ranked as moderate investors. So everyone was agreeing that they are moderate. But here's a problem. Bob and Sue, they thought moderate meant that they would not lose more than 10% if the markets go south. On the other hand, their advisor thought something entirely different, as we will soon see. So I want to share something that I think you will find important here, because this can mean the difference between whether you succeed or fail in retirement. You can really mess up your financial security if you don't understand what's going on. So to help Bob and Sue, we input their portfolio holdings. We ran this report for them. And they have about 70% of their money in stocks. The rest, it's basically bonds and cash. And that's interesting because right away they said, hey, I thought we were 50-50, 50% stock and 50% bonds. Well, guess what? They were 50-50 back when they started. The problem is, with the tremendous growth in the market that we've seen recently, their stock positions, they got bigger. And now they're 70-30, 70% stock, 30% bond and cash. So in other words, a lot more risk has been added to the table than they realized. And you should be thinking, wow, it looks like they're taking on a lot more risk than they thought they were. So let's take a look at the worst historical returns that their exact portfolio has experienced. Now remember, they said they don't want to lose more than 10% in a single year. So let's focus on the 1-year number. Their worst year that they had was back in 2008. And the way their portfolio is constructed right now, they could be down 32%. You know what that means? If we were to see something similar to another 2008 again, these folks are exposing about 1/3 of their portfolio to loss. They might see their $2.5 million go down to about $1.7 million in a single year. That's a loss of $800,000. That's about 3 times the amount they're comfortable losing in a single year. Now, I've got a question for you. Do you think this portfolio here matches their definition of moderate? Where they said, hey, we don't want to lose more than $250,000. Yeah, I don't think so. This is how people can get in trouble. This is how you can get in trouble. If you don't know what your portfolio risk is, you really could get hurt. And that's why we put something together for you today. You'll learn how much risk you're taking, how much money you can lose in your portfolio, and how this will affect your ability to retire and live your ideal lifestyle with a Cornerstone Retirement Risk Assessment. So let me explain how this works. First, we'll get some basic information from you. We'll take a look at how you're invested, and then we'll sit down with you and show you the amount of risk you're taking, and we'll share with you some of the strategies that you can use to protect yourself. And when it comes to retirement planning, this is one of those areas where you can really move the needle, especially in today's challenging environment. And for about 90% of the folks we meet with, we're able to show them strategies to significantly reduce their risk, yet still earn good rates of return. So if you've saved at least $250,000 for retirement, give us a call now for your free strategy session. We've helped thousands of clients retire securely, and this simple risk assessment, it's something that can mean the difference of today's high inflation and market volatility from derailing your retirement. So give us a call. And when we come back, we're going to look at strategies to significantly reduce your risk, yet continue to earn good returns. We'll be right back.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. Spend fun times with your grandkids, sharing the joy of their excitement about life. At last, you have time to breathe and rekindle the love of your life. Why? because you imagined what could be. You planned for retirement. So today, you own your future.
For trustworthy fiduciary-based guidance, call 775-853-9033.
Approaching retirement requires a shift in how you view your investment and income portfolio. Are you making the transition successfully? Author Chris Abts, in his latest book, Maximizing Your Income, will show you how to structure your income while avoiding 10 retirement pitfalls. You'll also learn 3 strategies to create sustainable retirement income. Learn to plan for potential healthcare costs and how to avoid 4 common yet costly Social Security mistakes. The information you gain from this book may help you retire sooner and help you stay retired. Get your complimentary copy today at MaximizingYourIncome.com and take control of your retirement.
Behind every photograph is a story. How will your life story be told?
We got the house of our dreams. Thank you for the down payment, Mom and Dad. It helps so much.
20 years ago, I remember hugging you just like this, Dad. Thank you for teaching me strength.
Say hello to Emma. Mom, you gained the title Grandma and a new best friend. She has your eyes, and I know she'll have your heart.
Create a legacy, a story worth telling. To learn how, call 853-9033.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
Stay informed on the latest news and events affecting retirees at cornerstoneway.com.
Welcome back to Redefining Retirement, where you can count on straightforward and objective advice on how you can make the most out of every dollar you save for your retirement. I'm your host, Chris Abts from Cornerstone Wealth Management, and today we're learning how to determine if the risk you're taking in your investments, if it's in line with your expectations, and that it won't destroy your retirement if we experience a recession. Because all too often, you think you're taking one level of risk, but in reality, you're probably taking far more risk than you thought. So let's take a look at a very common set of numbers that we see in today's marketplace. You know, when people just like you call our office and they come in, they sit down with one of our fiduciary advisors, and when we run an analysis of their portfolio, this is what they tend to see. So whenever we talk about average rates of return and the risk that you're taking, I like to use a bill curve. Now it's called a bill curve because it's shaped like a bill. Now the center line, that's your average rate of return, your annual average rate of return. And the sides or the edges of the curves, they represent your best potential year that you might get and your worst potential year. Now, the wider the bill, the wider your portfolio returns, how they might deviate from the middle line in any particular year. And when we analyze a portfolio, we find that, hey, the folks might average, say, a 6% return. That's fairly common. And what that means is maybe that's somewhere between a 5 to 7% annual return. So somewhere in that range, that's what you should expect. So given how your portfolio is constructed, very common. Now, let's take a look at the range of returns. And you know, when you're invested in a portfolio, you're not going to get your, say, 5, 6, 7% every year, are you? So it's just an average that you can expect to earn over time. So the sides or edges of the bill, those represent the range of returns you might get in any single year. So on the right side, we have the best return you can expect, and then on the left side, we have the worst return you can expect. And in the best year, hey, you might be up, say, 32%. And last I checked, if your portfolio is up 32% in a single year, you're probably not going to be upset. In fact, I don't ever remember anyone being upset with returns like that. Instead, you're going to say, wow, that's fantastic. But on the other hand, if you're in your worst year, maybe you're down 40%. And this, it's very, very common. So when we run an analysis on a portfolio, it tells us this portfolio, as currently constructed, should average somewhere around 6%, maybe 5, maybe 7, but let's call it 6. And in order to average 6% over time, this person has to risk 40% of their money. But in a good year, they might make as much as 32%. So there you go. That's a fairly common portfolio, and we see this all the time. And it wouldn't surprise me to find that you're not too far off from these numbers yourself. And normally, when we show folks the results of the analysis that we ran, you know what they say? They say, look, I'm okay with the 6%, and I certainly don't have a problem if we earn a positive 32% in a single year, but they really don't like the negative 40% loss in a single year. Just like you might not like that number. Then what do? We say, look, would you like help to structure your portfolio in such a way that you bring the risk down, but not necessarily the return? So what if you could get a similar average rate of return with not so far down when times are bad? That's kind of a no-brainer, isn't it? And if you incorporate those strategies, and if you have a portfolio where the volatility is low, you might end up with something like this, where you still might average that same 6% return, where your best year might still be plus 32%. In other words, your best year, it's about the same, but your worst year, maybe it's only a minus 19%. And which would you rather have? If you're going to get that 6% average return, would you rather risk 19% of your principal or 40% to get the same outcome? In my opinion, the answer is pretty clear. And when it comes to your long-term financial security, this is an area where so many retirees make big mistakes. Mistakes that have the potential to literally destroy your retirement. And that's why we put something together for you today. You'll learn how much risk you're taking, how much money you can lose in your portfolio, and how this will affect your ability to retire and live your ideal lifestyle with a Cornerstone Retirement Risk Assessment. So here's how this works. First, we'll get some basic information from you. We'll take a look at how you're invested, and we'll sit down with you and show you the amount of risk you're taking, and we'll share with you some of the strategies that you can use to protect yourself. Now, when it comes to retirement planning, this is an area where you can really move the needle, especially in today's challenging environment. So if you've saved at least $250,000 for your retirement, give us a call right now for your free strategy session. Folks, we've helped thousands of clients retire securely, and this simple risk assessment, it's something that could mean the difference of today's inflation and market volatility from derailing your retirement. So give us a call. That's our show for this week. Thanks for watching, and I look forward to seeing you next Sunday.
Jolly good show.